In the last 3 weeks, around $2.7 trillion quietly vanished. Not from a failed startup, not from some offshore scam. It vanished from the largest, safest, most trusted companies on Earth. The same handful of names sitting inside almost every retirement account in America right now. This was not a crash. Not yet. It was something quieter, and in a way more unsettling. A crack. The first hairline split in a story the entire financial world has been leaning its full weight on for 2 straight years. The story was simple. Artificial intelligence would change everything, so you should pour everything into it. And the world listened. Trillions of dollars went in. Then, over a few days in June, the people who put that money in began asking one very simple question. A question that, once it is said out loud, is almost impossible to take back. Where is the return? This is the story of how the biggest bet in financial history started to wobble. Who made the bet? Who gets hurt if it breaks? And what it actually means for you, even if you've never bought a single share in your life. Start with what just happened, because it happened fast. Over a single week, the Nasdaq, the index packed with America's largest technology companies, slid nearly 5%. That can sound small. At this scale, it is enormous. According to reporting, the group of giants often called the Magnificent Seven, together with the chipmaker Broadcom and the software company Oracle, lost roughly $2.7 trillion in market value across the month of June. You have known those Magnificent Seven names your whole life, even if you never thought of them as a group. The maker of your phone, the company behind your email, the store that delivers to your door, the search engine you use today. For years, they did not just rise. They rose together, relentlessly, dragging the entire market upward behind them. And one company sat at the very center of it all, Nvidia, a chip maker that, not long ago, most people outside of gaming had never heard of. Its chips became the single most important ingredient in artificial intelligence. The shovels in a global gold rush and the hunger for them turned it into one of the most valuable companies ever to exist. Nvidia was the boom made physical. So when doubt finally crept in this month, everyone watched names like that one first, because they had the furthest to fall. Hold that loss number for a second. 2.7 trillion. That is larger than the entire yearly economic output of most countries on the planet. And it did not drain away because these companies failed or got caught doing something wrong. It drained away because investors started to doubt a promise. To see why that doubt is so dangerous, you have to understand the size of the bet sitting underneath it. This year alone, 4 companies, Alphabet, Microsoft, Meta, and Amazon, are on track to spend close to $700 billion building the machinery for this technology. Data centers the size of small towns, specialized chips, power plants, concrete and silicon poured across whole counties. And that is just 1 year, and just 4 of the players. Look further out, and the numbers stop sounding real at all. The research firm Gartner expects total spending on artificial intelligence to pass $2.5 trillion this year. The bank Goldman Sachs estimates technology companies could spend more than $7 trillion by the early 2030s, building out the data centers to power all of it. $7 trillion on a single idea, on the belief that the idea pays off. That is the bet. And for 2 years, almost nobody questioned it. The spending was treated as proof of vision. The larger the number, the more certain everyone seemed to become. Spending billions was not a risk, it was a flex, a way of telling the world you understood the future and your rivals did not. Then, in June, something shifted. For the first time, that same spending started to look less like vision and more like a bill coming due. Investors who had cheered every announcement began doing something they had not done in a very long time. They started counting. They looked at the hundreds of billions going out, and they went searching for the money supposed to be coming back in. The profit, the new revenue, the proof. And what they found, or rather did not find, is what cracked the glass. Because here is the quiet problem at the center of the whole story. The companies pouring hundreds of billions into this technology have, so far, struggled to show that it is earning them hundreds of billions in return. A study this year from that same research firm Gartner found that businesses replacing workers with automated systems often fail to see a real return on the investment at all. Sit with how strange that is. The most expensive technology rollout in human history, and one of the loudest questions hanging over it, is whether it even pays for itself yet. There is a second number that makes the first one harder to explain. While these companies poured money in, they were also cutting people out. In the first half of this year, more than 150,000 technology workers lost their jobs, and according to reporting, more than half of those cuts named the same reason: automation, artificial intelligence. The very thing the companies were spending fortunes to build. Read that back slowly. The same companies spending record amounts on this technology were laying off record numbers of people and pointing at the technology as the reason they could. The machine was being funded, and the humans were being released, both at once, both in the name of the same promise. For a while, investors accepted that trade. Fewer workers meant lower costs, and lower costs meant higher profits, at least on paper. It looked efficient. It looked like the future arriving exactly on schedule. But efficiency only holds up as a story if the new tool truly earns more than the people it replaced. And that is the exact link that started to look shaky in June. If the technology is not yet delivering the return, then you are not watching a company swap workers for profit. You are watching a company spend a fortune and shed the people who used to bring in its income on the strength of a promise that has not paid out yet. That is the thought that began spreading through the market this month. And once enough people think it at the same moment, money moves. So, how did the world get here? How did one idea pull in trillions of dollars and the complete confidence of the most powerful companies alive? To understand the crack, you have to understand how the glass was made, and that story is where it gets uncomfortable. Every bubble in history runs on the same fuel. Not greed, exactly. Something more human than that. A story so good that doubting it starts to feel foolish. And the story behind this one was genuinely breathtaking. Artificial intelligence, the promise went, would not just be another tool, it would be the tool. The thing that wrote the code, answered the customers, drove the trucks, diagnosed the patients, and did all of it faster and cheaper than any human ever could. Whoever owned that future would own everything. And in a race for everything, the single worst thing you can do is hesitate. That one fear, the fear of being left behind, is what turned a promising technology into a spending frenzy. If a rival announced a $10 billion data center, you announced 20. If they bought 100,000 chips, you ordered twice as many. Every executive understood the same brutal logic. If this technology turned out to be as big as everyone said, the company that underspent would be left behind forever. So nobody underspent. They could not afford to look cautious for even a single quarter. And the market rewarded them for it. For 2 years, the more a company spent on artificial intelligence, the higher its share price climbed. Stop and notice how unusual that is. Normally, spending staggering sums of money makes investors nervous. Here, it did the opposite. The spending became the proof. The bigger the bill, the bolder the vision, and the bolder the vision, the higher the price. A loop formed, and the loop fed itself, round and round, higher and higher. But there was a second loop underneath that one, a quieter loop. And this is the part that makes some analysts deeply uneasy. Look closely at where a lot of the money in this industry actually flows, and you start to notice something strange. It often seems to travel in a circle. Here is the shape of it. In plain terms, a giant chipmaker invests billions into an artificial intelligence startup. That startup then spends the money buying chips from the very same chipmaker. Or a cloud company invests in an artificial intelligence lab, and the lab turns around and spends that investment renting computing power from that same cloud company. The money goes out one door and comes back in through another. And on the way around, it makes everyone's revenue look bigger. Imagine a shopkeeper who hands his neighbor $100, and the neighbor walks straight back in and spends it in his shop. The till rings, the sales look real, but no new money ever entered the street. According to critics and analysts, a version of this circular financing has become common across the artificial intelligence industry. And the worry is simple. When companies are partly funding their own customers, demand can look strong and healthy when some of it is really the same dollars moving in a loop. Now, none of that is necessarily wrong, and the companies involved argue these are normal strategic investments in a fast-growing field. That may well be true, but it means the picture is far harder to read than it looks from the outside. And in June, investors began to wonder how much of the demand they had been celebrating was real outside hunger for the product, and how much was the industry quietly buying from itself. This is the thing about bubbles. They are almost impossible to see from the inside, because everyone around you is making money, and the money is completely real, right up until the moment it is not. History is full of this exact pattern, and it rhymes almost perfectly. Around the year 2000, the world fell in love with the internet, and the world was right. The internet did change everything. But that correct belief still inflated one of the largest stock bubbles ever recorded. Companies with no profit, sometimes with barely a product, were valued in the billions, purely on the promise of what the internet would someday become. Investors were not wrong about the technology. They were wrong about the price and about the timing. When the gap between the promise and the profit grew too wide to ignore, the whole thing collapsed, and trillions in paper wealth vanished. There is a lesser-known half to that same era, and it lines up even more closely. To carry all the internet traffic everyone expected, telecom companies borrowed enormous sums and laid vast networks of fiber optic cable across the world. They were certain demand would soon explode to fill every strand. For a while, the spending looked like genius. Then the demand arrived far more slowly than promised, and much of that cable sat dark and unused for years, while the companies that built it drowned in debt. The technology was real. The build-out was real. The timing was a catastrophe. Swap fiber optic cable for data centers, and you can understand why some analysts get nervous reading today's headlines. Notice what that history does and does not say. It does not say the internet was fake. It says the internet was real, and the bubble around it was still a bubble. Both things were true at the very same time. That is the uncomfortable possibility now sitting underneath artificial intelligence. What if the technology truly is world-changing, and the bet on it is still wildly overpriced? What if, once again, both of those things are true at once? For 2 years, the market simply refused to hold that thought. In June, for the first time, it allowed itself to. And the moment a market lets itself ask whether the price has run ahead of reality, the spell begins to break. So if the bubble really is cracking, the next question is the one that matters most to you. When something this enormous deflates, who actually pays for it? Who is standing closest to the glass when it breaks? Because it is almost never the people who built it. Before we talk about who pays, the honest part. The part that keeps this from being just another doom story, because the people on the other side of this are not fools. Their case is strong, and it deserves to be heard properly. This technology is not vapor. It is already writing real code, handling real customer service, speeding up real research in medicine and science. Some companies are genuinely more productive because of it. And unlike many of the hollow startups of the year 2000, the giants spending this money today are wildly profitable, with real customers, real products, and mountains of cash in the bank. This is not a pile of fantasy companies. It is the most powerful businesses on earth making an enormous, deliberate bet with money they actually have. And every world-changing technology in history looked wasteful and oversized at the start. When electricity arrived, when the railways were laid, when the internet went mainstream, the early spending was chaotic, and plenty of money was lost by people who showed up too early. But the technology still reshaped the world, and the ones who survived the messy beginning ended up owning the century that followed. So it is entirely possible that what we are watching in June is not a bubble bursting at all. It might be a correction, a reality check, the market catching its breath and repricing a very real thing that simply ran ahead of itself before it climbs again. Honest people can look at the same numbers and land in completely different places. And anyone who tells you they know for certain how this ends is trying to sell you something. But here is what is not uncertain. When a bet this size moves, in either direction, it is not the people who made it who feel it first. Think about who actually owns these companies. You might never have bought a share in your life and still be tied to this more tightly than you realize. If you have a retirement account, a pension, almost any ordinary investment fund, there is a very strong chance it holds these same few giants. Over recent years, this small group of technology companies grew so large that they came to make up a huge slice of the entire market, which means their rise quietly lifted the savings of millions of ordinary people who never followed a single earnings call, and their fall would quietly drain those same savings, whether or not those people ever chose to bet on artificial intelligence at all. That is the part that rarely makes the headline. The trillions are not abstract. A piece of the $2.7 trillion that vanished in June belonged, indirectly, to teachers, nurses, retirees, and anyone with a few decades of savings riding inside a simple index fund. They never sat in a strategy meeting. They never approved a data center, but they are holding a share of this bet all the same. Now look at who is standing furthest from the glass. The executives who set this spending in motion are, for the most part, paid in ways that already rewarded them richly on the way up. According to reporting, many insiders across the industry sold large amounts of stock during the climb, perfectly legally, locking in fortunes built on the very optimism now being questioned. The people who shaped the story got to bank the best years of it. If the promise pays off, they win enormously. If it does not, they have already taken a great deal off the table. And then there are the workers. The 150,000 and counting who lost their jobs this year, many of them told the reason was artificial intelligence. They are carrying the cost in the most direct way of all. They were spent like a line on a spreadsheet, traded for a tool that, by the industry's own consultants, may not even be delivering the promised return yet. If this turns out to be a bubble, they paid first. And they paid with their livelihoods, not their portfolios. So when you hear that $2.7 trillion evaporated, do not picture a billionaire frowning at a screen. Picture the quiet, even spread of it. A little from a pension here, a job lost there, A retirement pushed back by a year for someone who never knew their future was wired to a data center in a state they have never even visited. There is one more layer to this, and it is the one that outlasts whatever the market does next. Underneath the money is a question of power. Whoever ends up owning the data centers, the chips, and the models does not just own a profitable business. They own the thing that a growing share of the economy is being built to run on. Every company that wires artificial intelligence into its core becomes a little more dependent on the few giants who supply it. The boom is not only a race for profit, it is a race to own the ground that everyone else will eventually be standing on. And that kind of power does not show up in a single day's stock chart. It settles in slowly, and it tends to stay. So what happens next? Honestly, nobody knows. The crack in June might seal over, and the climb might resume, and the believers might be proven right. Or it might widen, slowly, the way these things usually break. Not in one dramatic afternoon, but in a long, grinding reckoning between the promise and the proof. Either way, the lesson is older than artificial intelligence, older than the internet, older than all of it. When the whole world agrees that something cannot possibly lose, that is usually the precise moment it becomes the most dangerous. Not because the idea is wrong, but because the price has stopped listening to reality. So watch where the money actually flows. Watch who is quietly buying and who is quietly selling. And remember that the people most certain of a sure thing are rarely the ones still holding it when the certainty runs out. This has been Money Mechanics, educational, not financial advice. Keep your eyes open and watch the money.